I'd like to thank the organizers for inviting me to present my joint work with Juhani Linema, my colleague at Booth, and Adair Morris, my former colleague at Booth, who's now at Berkeley. This is an honor to speak in Bill Sharp's conference in honor of Bill Sharp. Also, as a Wharton grad, it means a lot to be invited to come present at this conference. For background, I had done a lot of work on hedge funds. Juhani had done a lot of work on mutual funds, and Adair had done a lot of work on private equity funds. And we were all sitting around talking, having a cup of coffee, like academics like to do. And we said, well, how does an organization like BlackRock fit into those hedge fund, private equity, mutual fund delineations? And we realized it does to a certain extent, but it's overarching. And this is what we realized was an opportunity for us in terms of academic research. So for background, if you look at total institutional capital, when I say institutional capital, I mean capital in pension funds, endowments, sovereign wealth funds. If you look at that, that's about 64 trillion worldwide. In comparison, just to get some background, retail mutual funds held about $27 trillion at the same time. Of the 64 trillion that the institutions held in terms of assets, they delegated 48 trillion, which represented about 30% of worldwide investable assets at that time. 5 trillion was held in what we would call institutional mutual funds. So these are often sometimes picked up in the academic research. And 43 trillion was delegated to what we're going to call strategy-specific investment vehicles in which asset managers combine or hold the assets of a small number of clients. They combine these small number of clients or these investment vehicles into what is often called we're going to call a fund-like structure, and we're going to refer to it as an asset manager fund. And they do so for marketing purposes, which I'll talk about as I go forward. Despite the size of this sector, there's not much academic research on this aggregate institutional asset management sector. And the reason really comes down to institutional asset managers, the asset management sector, the institutional side is not required to make public disclosures. So unlike retail mutual funds, there's just no readily available commercial databases. Despite this, there is some, however, academic research. A lot of research that focuses on particular types of institutions using like the 13F databases, particular samples of asset classes. There's some studies that look at asset managers specifically, and they're typically looking at issues of investment making, how do they make decisions, often with respect to taking into account agency issues, and a bit about performance. Nonetheless, despite the size of this sector, there's not much academic research if we think about it relative to like the academic research on retail mutual funds. So what I'm going to talk about today, my outline, to start, I'm just going to provide basic descriptives of this sector. Going to add up, also going to estimate the aggregate fees paid in the sector, and this kind of speaks to the recent literature about the size of finance. I'm also going to come up with some descriptive statistics about tracking errors to get an idea of how active is this sector versus passive. After that, I'm going to do something very simple. We're going to calculate gross alphas. Basically, we're going to take the performance of the institutional side of asset management, represents about 30% of total worldwide investable assets. And we're going to subtract off the performance of some basic asset class benchmarks. We're going to come up with a gross alpha. We're going to use that to speak about what we often call the adding up constraint. And this is an issue that was raised in '91 by Bill Sharp when he talked about the arithmetic of active management. So we're going to come back and we're going to think about this when we have 30% of total worldwide investable assets being held by an asset class. How does just the general performance of that asset class, what does it imply for everyone else? From there, we get to I'm going to say the meat of the paper. We're going to say, okay, what explains the performance of this sector? And the method we're going to use to get at that comes from Bill Sharp's 1992 model, the style model. And we're going to use that to dig into what explains the performance of the institutional side of the asset management industry. And this is a great model which I'm surprised, I'll talk about more when I go forward. It's actually, I would say, underutilized in academia. Academic research, it's underutilized. And actually, I guess as an aside, Ken French discussed our paper yesterday, and he said this was a cool model, cool approach. So I'm hoping to see more and more of it used going forward. Finally, we're going to get at this issue of, if you're an institutional investor, you have the choice of managing your assets in-house or delegating those assets. During our sample period, as I showed, you went from most of the assets on the institutional side were delegated to asset managers. And we're going to sit back and we're going to ask this counterfactual question of, if I were an institutional investor, if I used some simple mean variance rules, how well could I have done if I'd managed the assets in-house instead of delegated those assets to asset managers? And related to this point, we're going to talk about the rise of ETFs and what does that imply about the institutional side of the asset management industry. So to start, to give some background, when institutions delegate their assets, they typically do so through consultants. They hire consultants to come in, help them figure out their strategy allocations, assist them in evaluating and choosing asset managers. And I'm sure the practitioners are like, you are familiar with this process. Academia was surprisingly, we're kind of ignorant, surprisingly, about that. But you have these consultants. You can think of them as the gatekeeper to the asset managers, to the institutions. Asset managers often disclose their performance to the consultants in order to market their products. And these consultants take those disclosures and they build databases that have quarterly assets under management, client counts, fee structures, monthly performance. And what we did is we went out and obtained one such database. We obtained a large database from a major global consulting firm. The database includes over 20,000 what we're calling asset manager funds, which are these aggregations of those investment vehicles, with over 3,000 asset managers and over 25 trillion assets under management in 2012. Now the first question when we obtained this database is we said, what sort of biases could there be in this database? How clean is this database? Can we believe this database? The first point is the consultant's business model relies on the integrity of the database. They have over 100 researchers basically following up, cleaning the database, making sure the database does a good job in representing what the asset managers are doing and the classification of the strategies by the managers. Moreover, the managers who report over the sample period, became more and more GIPS compliant. So we can be have more and more faith in the data that they're reporting to the consultant. Moreover, the consultant is very cognizant of the issues that we academics worry about with respect to incubation and survivorship bias. Nice thing, for each strategy or fund that's put in the database, they give us a creation date. So that allows us to go in and strip out any backfill data. Moreover, they're very good about including dead products in the database, so we don't have to worry about survivorship biases. Nonetheless, it's a new database, questions arise. So we carried out 3 sets of tests to dig into, are there nonetheless any of these selection biases, survivorship biases in the database? The first thing we did is we said, okay, we came up with some benchmarks about asset class weights. Does the database underweight or overweight certain asset classes? Very close to our other benchmarks, our third-party benchmarks. The second thing we did is we were worried about that maybe asset managers only report their better performing funds to the database. This is an issue a lot of times that shows up when we start to do research with the hedge fund commercial databases. So what we did is we said, okay, we have for each manager in the database, we have the manager's total assets under management, and we have the assets for which the manager reports performance. If the managers are selectively only reporting their better performing funds, we would expect a negative relationship between performance and the percentage of assets that the manager reports to the database. In contrast, as you can see, I don't know if there's a laser. If you see, if anything, we find a positive relation. So actually goes in the opposite direction from what we were expecting to find if the managers were engaging in this strategic behavior with respect to reporting. As I go forward, I'll put out some more tests that we do going forward, but this is something that we're very conscious of, something that we get pushed back a lot in academic conferences about. The data, when we look at it, to start, what we do is we benchmark the data against Pensions and Investments. Pensions and Investments magazine carries out surveys annually of the asset management industry. They provide data that allowed us to estimate the institutional side. So if using those pensions and investment surveys, if you look in 2012, there's about this is the 47 trillion we're talking about institutional assets that are delegated. If we come up with estimates of worldwide investable assets, that's about 174 trillion, and this is where we're getting 27 to 20, depending on the year, 27 to 29% of worldwide investable assets represent these delegated institutional assets. In terms of the database that we obtained, in 2012, held about 28 trillion assets under management. It's about almost 60% of the total assets in pensions and investments. And overall, we give coverage of about over 80% of the asset managers, the individual asset managers that show up in pensions and investments. In terms of the characteristics of the funds, the median fund holds about $285 million. The mean is larger, over 1.5 billion, and that difference, that skewness is driven by the fact that the database includes the institutional mutual funds. Institutional mutual funds that are going to have a large number of investors in them. In contrast, at the median, we're picking up these investment vehicles with a small number of managers, a small number of institutional investors. The median fund holds about 6 clients with assets per management under about 50 million. Now, once we put this together, immediately what comes to mind is this issue of what is the size of the finance sector? So Thomas Philippon has this important paper, recent paper, where he estimates what is the annual cost of financial intermediation. And he comes up with it's about a little less than 2% of investable assets. And this has spurred a lot of questions in academia about what is the size of the financial sector, people debating whether it's too big, too large, and so on. Nonetheless, it's important to understand the size. If we take some follow-up research by Greenwood and Scharfstein and do some extrapolation, securities intermediation accounts for about $726 billion in terms of cost worldwide. You can go to 2012 and you can do some back-of-the-envelope calculations, kind of like what Ken French does in his presidential address for the US, but you can do it worldwide. And what you find is the cost for retail mutual funds about $87 billion. Worldwide individual trading is about $313 billion. But the sector that's really missing is what's the cost or what are the fees paid for the institutional side? So the database has the pricing structure for each fund. And these funds have nonlinear pricing structures, and for each fund, they have the pricing structure. And what we do is we go in using the asset weights, and we estimate what's the total fees being paid on the institutional side of asset management, and we get an estimate a little over $170 billion per year over our sample period. If we look at the individual funds, on a evaluated basis over the sample period, it's about 48 basis points, equal weighted a little more. Importantly, if you look at the different asset classes, they line up with your what you would expect. US fixed income's the lowest, followed by global, then equities. Hedge funds, about 91 basis points. Importantly, this is just the management fee. That doesn't include the performance fee. We did some robustness. So we had the schedule, the nonlinear pricing schedule. So we came up with what if we use the midpoint? What if we use the lower bound in that maybe institutions are able to negotiate lower fees? Moreover, in the database, we have gross fees and net fees, so we can come up with an implied fee. And all of those estimates are pretty close over the sample period in this 170 to 150, anywhere about 150 to 170 billion per year. The next thing we do is we do this something very simple. We just say, okay, we have the performance of the asset managers. We can classify them into broad asset classes, US public equities, global public equities. Its institutional side of the asset management industry represents about 30% of total investable worldwide assets. Let's just subtract performance. What's this gross alpha look like? We're going to take it simple. We're just going to say, let's set the beta equal to 1, cluster the standard errors, using as if it's evaluated regression. When we do that, find a gross alpha of 119 basis points on the gross returns. Importantly, tracking error, 8.72%. This implies that there's some active management going on. If we go to the academic research about retail mutual funds, the average tracking error for an average tracking error for a retail mutual fund is a little over 7%. So this sector, we're finding this just simple gross alpha, and B, active management. If you look, we went through annually. One of the interesting things we did is we said, okay, we find the 119. What if we just take the average weight over the sample period in terms of each of the asset classes, use that and see how that determines performance? That works out on average at the bottom there at 82 basis points. And the difference is coming up from timing of the weights. So they seem to be doing well over this period, and it's not all coming from just changing the weights. If we go to the adding up constraint, one sector representing 30% of total investable assets outperforms by 119 basis points, we can convert this into dollars. That works out to a little over $400 billion per year. Excuse me, 172 going to the asset managers in terms of fees, the remainder representing returns to the institutions. Now you have this adding up constraint. This implies everyone else is underperforming by about 50 basis points. Now you could say, okay, you've set the beta to 1, maybe they're taking on more risk. So what we did next was, okay, let's just run a simple CAPM style regression and a couple important points. The betas are 1 or below 1 for all the asset classes. Alphas actually go up. If they were taking on more risk and that was driving it, we would expect them to go down. And moreover, the tracking errors still remain relatively high. Now, I said, okay, we've done this analysis this way, but then let's step back and let's think about the process that institutions go through when they delegate their assets. So you think about an institution, it develops a model to determine its strategy allocations, its asset allocations across the different strategies. Then the institution decides, okay, do I want to manage that asset allocation in-house, or do I want to delegate it to an institutional investor? When they delegate it, the typical criteria in terms of performance assessment is something like a net alpha relative to a strategy level benchmark, subject to an acceptable level of tracking error. So up to this point, we've just looked with respect to broad asset class benchmarks. Let's dig down into strategy benchmarks. So what we do next is we again run something similar to a CAPM, a single factor regression, against the strategy benchmarks. So in the database, each strategy or investment vehicle has a benchmark. There are 235 different strategies within the database. Within each strategy, each manager reports a benchmark. What we did is we said, okay, to start, let's pick the modal strategy within the benchmark, the modal benchmark within the strategy. Use that as the benchmark for each of those 235 strategies and see what performance looks like. Now, as I'll talk about in a minute, in an analysis like that, you have to be worried about strategic choice of benchmarks by the managers. We're going to talk about that going forward. But to start, we just said, hey, let's just put the modal benchmark in there. When we do that, we find overall, when we aggregate up, we continue to find a positive gross alpha and a positive net alpha. The beta, again, below 1. On average, in the aggregate, it's 0.88. Moreover, we find tracking errors similar to the level that Del Guercio and Tkach find for pension funds. Now, we then further dug in and we said, okay, we're finding this performance, this outperformance. What's going on? And I want to point to a couple things. So we have, for the asset managers, we have, for each of the 6 broad asset classes, we have the average return, we have the standard deviation of returns, and Sharpe ratios. The second set of 3 columns, we have the same statistics for the asset class benchmarks. And in the final set of 3 columns, we have them for the strategy benchmarks. I want to focus on the strategy benchmarks, and the asset managers. And I want to look at the final two rows. First thing, the standard deviation of returns for the strategy benchmark compared to the standard deviation of returns for the managers are very similar, almost identical. So if we exclude asset blends and hedge funds, the standard deviation is 10.33 for the asset managers. If we look at the strategy benchmarks, it's 10.36. Second point, compare the average returns. If we exclude the asset blends and hedge funds, the average return for the strategy benchmarks, 4.83%, 5.23% for the asset managers. These translate into the Sharpe ratios. If you see the Sharpe ratios, if we exclude the asset blends and the hedge funds, is 0.3 compared to 0.26 for the strategy benchmarks. Nonetheless, we need to be, we're cognizant. Now, there could be some strategic choice of benchmarks going on in there, but we're gonna see what we can do to address those concerns. Nonetheless, it looks like the asset managers, at least compared to these strategy benchmarks, are doing something well. Other thing I'd like to point out, and this is something that we found really fascinating. If you look at the US fixed income and the global fixed income, if you look at the average returns, standard deviations, and the Sharpe ratios, those sectors did really well over our sample period, which was 2000 to 2012. Asset managers did well, and the benchmarks did well. We were scratching our heads about this. We were like, what was going on? When we dug into the annual data, what we realized is it's driven by 2008, 2009, 2010. And what was going on is the managers were taking on lots of credit risk at that time, which was driving that outperformance. So we're worried about sample selection biases, so we did a couple things. First thing we did is we said, okay, we have hedge funds in there and we have asset blends in our analysis. Hedge funds, it's hard to classify hedge funds as one class, one asset class. They're heterogeneous. So why don't we strip those out? Moreover, asset blends, it's hard to think about what's a good benchmark for the asset blend. So we strip those out. Again, we find similar results. Then we said, okay, we right now, in our base analysis, we throw away all backfilled returns. But what if we restrict our sample to managers who only report less than 1 year of backfilled returns? So we strip those out. Again, we find similar results. Okay, and then we said, well, maybe it's sample period. So let's look at post-2006. Similar results. Then we said, okay, we have the coverage percentage. What if we only look at managers who report performance for at least 85% of their assets under management? Results look even stronger. So it does not appear to be, we're not finding anything on this selection bias. Nonetheless, there's the issue of the benchmarking. Is there strategic benchmarking choice being carried out by the managers? So in our analysis, we use the modal benchmark, but who knows? Maybe there's systematic gerrymandering going on by the managers. But what's important to point out, if you're gerrymandering, your incentives would be to pick a lower risk benchmark. Make your performance look better. But when we run this analysis, the betas we're finding are below 1, and the R-squareds are high. So we can't fully rule out the gerrymandering explanation, but it doesn't look like it's the major driver. Now we get to the meat. This is what I call the meat of the paper. We said, okay, we go through this analysis. We compare them against the broad asset classes. We compare them against the strategies, and we find they're performing well. The natural question is, what are they doing to generate that performance? And we went back and we said, we found this paper in 1992. by Bill Sharp. And we said, this is really cool. And we implemented it. And the idea is follows. If you read a lot of the advertising material by asset managers, they go out and they advertise themselves as, we provide multidimensional risk exposures. We market smart betas, tactical betas. In our paper, there's a great quote about, by John Cochran when he talks to a hedge fund manager, and the hedge fund manager says, you know, my exotic beta is what you think of as an alpha. So asset managers market themselves along those lines. So we said, hey, let's take the Sharp framework and let's do the following. Let's think about an investor who can trade a set of factors, and we're going to run a constrained least squares regression on that manager's strategy. We're going to regress the manager's returns on those factors. We're going to constrain the beta coefficients to sum to 1 and to be greater than or equal to 0. Doing so allows us as researchers for each of these strategies to recover the long-only portfolio that best replicates, best mimics the performance of each fund. What we do next is we calculate the returns on this mimicking portfolio, use that as the benchmark, and then difference out the manager's return from the return on the style portfolio. And you could think about this like an alpha. We do this for each fund. We do this within asset classes. We do it within sample. We do rolling out of sample. We do a jackknife where we we center it on a month and drop the months around it and that specific month. So we do a bunch of different ways. We apply different approaches. And these are our findings. When in the 1992 paper, there was a set of factors. We augmented those, we used what we could find which were most similar to the factors used in the original paper. Moreover, we augmented it with emerging markets and items along those lines. What we have here are the average coefficients within each asset class and in aggregate. And you can look at this and you can interpret it as the average weight on the benchmark for funds in that asset class. So if we look at the US equities, the average weight is a little less than 10% on the Russell 3000, 28% on the Citigroup S&P 500 value, 23% on growth, 15% almost, a little less than 15% on S&P small cap. So we recover these weights for the mimicking portfolios for each fund within each asset class. The next thing we do is we just calculate the aggregate alphas. And this gets interesting. When you look at the gross alphas, they're all not significantly different from 0. What this is saying is that when we look using those single factor models, we're getting these alphas. But what really is going on is the asset managers over our sample period are generating that performance because they have exposures to multiple factors. And they did a relatively good job with those exposures over the sample period. So if we look at the gross, nothing significant. We move to the net. You actually find possible evidence of underperformance when we take into account the fees. So these style portfolios, they're explaining what these asset managers are doing. It's this, I don't want to call it smart beta, these beta exposures explain the performance of the managers. Next thing we did is we said, okay, are investors willing to pay, are investors paying for, are these institutions paying for the smart beta or the beta exposures, or are they paying for alphas? And what we do next is we regress fees for each fund, the return on the style portfolio and the residual return, which represents the alpha. And when we do that, we find evidence for both on average. However, when we look at the equities, most of the weight is on the beta exposures, the style portfolios. However, for fixed income, it appears to be the fees are higher if the managers are generating it through the alphas. So we find evidence that investors investors seem to be willing to pay for both alphas and the style portfolio performance, the beta-driven performance. The next thing we said is, okay, asset managers generate these alphas relative to single factors. However, when we go into this sharp analysis that explains performance, real preference, institutional investors use these asset managers, there must be some value there. And we said, okay, what would institutional investors do if they were on their own? If they didn't have asset managers? On the one hand, if institutional investors could trade the tactical factors on their own at a reasonable cost, then asset managers aren't really adding value. In contrast, if institutional investors didn't have access to asset managers, and they didn't have access, they would only just hold the market, then you can think about asset managers adding value. So what we did in the final step of the paper is we took the factors we used in the style analysis, took those same factors, we used the asset class weights from the database. So we said, okay, let's assume that the institutional investors, they already know their asset class weights. We can see those revealed asset class weights in their delegation over the sample period. And let's construct some mean variance optimal portfolios within each asset class. Then we're going to say, we say, what cost of managing in-house would make an institutional investor indifferent between delegating and managing in-house? So to start, up at the top, we have the gross returns and the net returns for asset managers and their Sharpe ratios. Below that, we have the average returns and the standard deviations and the Sharpe ratios for the replicating portfolios. Interestingly, using those factors and using the asset class weights, gross returns are actually higher for the replicating portfolios. We then say, okay, what cost? Now these are just gross returns when we do these replicating portfolios. We haven't taken into account any of the costs of purchasing those factors. We haven't taken into account any cost to manage assets in-house. We're taking into account nothing. We're just saying, let's just look at the gross returns. But then we can say, what is the indifference point? What is the cost of managing assets in-house that would make me indifferent between delegation and in-house? And what we find is it varies anywhere between 43 to 73 basis points. This is over the sample period 2000 to 2012. The next thing we do is we say, okay, what's the distribution of institutional mutual fund fees over that sample period? Weight the fees again by the asset class weights that we get from the database. And we find, hey, the median is about 86 basis points. So it seems relatively close with respect to this indifference point over the sample period. Importantly, however, there really wasn't that much liquidity in the institutional mutual funds over the sample period. So maybe on the margin, an institutional investor could have delegated, moved to the institutional mutual fund, but there wasn't a lot of liquidity such that you could see large swings of assets from the sector to the institutional mutual funds. The next thing we did is we said, okay, at the end of our sample period, ETFs are showing up, ETFs are becoming more liquid, prices on ETFs are falling. If we do the same thing where we weight by the asset classes, come up with the weight for the ETFs, that works out to, excuse me, 26 basis points. This is saying, hey, going forward, it seems to imply that any comparative advantage that the asset managers had on the institutional side is being eroded by the rise of the ETFs. So, how much time? In conclusion, delegated institutional assets represent about 30% of total worldwide assets. Institutions pay over about 170 billion in fees over our sample period. There's a lot of active management going on in this sector. Now, that's an important point. The literature on active management is primarily focused on retail mutual funds. The institutional sector is about twice as large. So we've you could think about it, the academics are underestimating the size of active management in the financial services industry. We find evidence of the outperformance. The Sharpe model does a great job explaining the outperformance and showing that it's arising from the factor loadings. And importantly, ETFs are going to change the structure of the industry going forward based on what we're finding. I look forward to Bob Litterman's comments, and thank you. I thank the organizers again for inviting me to present.
Well, as I say, it's a pleasure to be here, and you know, I've spent most of my career in active management, so you might think that I come with a point of view to be skeptical of this paper that says that actually it doesn't say asset management doesn't add value. It says that asset management adds about as much value as you would expect, and the way it does it is by loading on these factors. All of this kind of makes sense to me because, you know, as a quantitative active manager, all these years we've tried to add value by tilting on factors that seem to outperform the market. So it all kind of actually made sense. I don't really have too much to criticize about it. I thought it was a very nice paper, very well done. The one thing I would point out at the beginning, though, is this, the paper talks about an analysis from a consultant database. It doesn't tell you which database it is, so it makes it a little hard to know how to react to that and how to follow up on that. Although I would say that the concern one has when you have a big database like this, it's a great source of new information to analyze. But my experience with large databases has always been that when they're used for a specific purpose, and in this case it would be used by consultants to try and support analyses that are done for clients and recommend asset managers, that's a little bit different than the analysis done here, where you're taking the entire database and asking what does it tell us as a whole. And so you have to worry in those cases that you may be kind of aggregating up corners of that database that haven't been looked at very carefully, and you worry about the quality of the data. Having said that, I don't think there was anything in the analysis other than, and I guess I'll point to this. So these, I just on the first slide, these are all the different things, and I think Joe did a good job of kind of talking through what the points were. And then as we go through it, the third point, which kind of documented the extent of active management, and I think Joe mentioned this as well, it seems that the tracking error was surprisingly high, and so it makes you, now there were various measures of tracking error. So in the first case, there on the first bullet under point 3, that was tracking error relative to broad asset class benchmarks. Now, of course, many of these funds are no doubt managed relative to more strategy-specific benchmarks, then clearly when you go down to that, so for example, a fund would be part of global equity, and then that would be measured relative to the MSI World. If that was actually an Asian equity fund, then in the strategy benchmark, we would look at this tracking error relative to the MSCI Southeast Asia. And you can imagine, and it's not surprising that that tracking error goes down, but it's still, when you aggregate over not just equity, but also fixed income and hedge funds, that 5.9 tracking error seems a little bit high to me. It might reflect the fact that this is I think a 13-year period, 2000 to 2012, so it includes the financial crisis, which obviously was a period of relatively elevated tracking error. Now then, if we get to the performance results, the basic result, you start out, you have 119 basis points better than the global benchmarks. Well, that's pretty good, although, 13 years, I would have to say, is a relatively short period of time. But nonetheless, over this period, those institutional managers have outperformed, and that's kind of interesting, and significantly outperformed relative to fees. So in some sense, that actually seems relatively surprising. Now, one of the things that I'll mention, it's not really a criticism so much, but often the authors here use the word timing. For instance, in this context, they talk about the performance not being driven by timing. Well, timing in this case really just refers to the changes in weights over the period under analysis, which was driven primarily by relative changes in valuation of equities versus fixed income, for example, and flows into and out of the fund. So it's not timing in the sense of managers being able to, or investors trying to time the market actively. And similarly, the paper talks a lot about alpha. And, these alphas are defined differently in different contexts. So, for instance, the 118 basis points of outperformance relative to the asset class benchmark is called alpha. Then later, when it's beta adjusted, it's also called alpha, and so on. So it's, the alpha term in this paper is used very generically. And so, for instance, the 119 basis points is just when you take the performance of the manager minus the performance of the benchmark, that's what's left. In the next part of the analysis, they look at, suppose we regress the returns of the fund on the benchmark, and then you get an average beta of 0.88. Now, one of the suggestions for where that outperformance might have come from was just taking more risk by having a higher beta. That turns out not to be the case. So when you regress on that beta and you get a lower, when you regress on the benchmark, get a lower beta, that actually implies the residual is even larger. So that goes from 119 to 199 basis points. On the other hand, when you regress on strategy benchmarks, which I think is the more natural thing to do, the beta stays the same, but the residual, again called alpha, is only 96 basis points. So that's probably, in some sense, the bottom line relative to as close as we can come, not actually knowing for sure whether we've got the right benchmarks or not. But, and then if we look across the different asset classes, you see a similar picture where the residual relative to the broad index is, I think, 119 basis points on average here. And then when you regress on the strategy benchmark, it decreases to 99. So, and it varies across the different asset classes in a way that's perhaps not too surprising. When we then go to the question of, which Joe mentioned is kind of the meat of the paper, and I think it is the most interesting part of the paper, where you say, what is driving these results? Well, they're being driven by these tradable factors. The only surprise to me there was that it actually shows up in the data so nicely. Certainly not a surprise that I think that's where most of the performance comes from. But just to think about it for a minute, when most active managers talk about, and these are primarily stock pickers, where their outperformance is coming from, they certainly don't focus on factor tilts. At least historically, what they focused on is stock picking and perhaps timing. Again, there's terms in the paper that talk about timing, talk about dynamic, talk about tactical, but just to be very clear, none of that is going on in this paper. These are regressions of the returns of each of these funds on various factors. You get a constant beta or exposure to those tilts, and that's what's driving this. So tactical in this context just means really driven by the factors, and there's no active management going on in terms of timing the factors or moving into and out of the different styles over time. So, but the bottom line is that when you do this regression, the style analysis, you find that the bulk, in fact, all of the outperformance is in effect driven by these relatively constant factor tilts. You also find a nice relationship between the fees that are charged relative to these different funds and their ability to, the more factor tilts they take, the higher the fees, and the more residual performance there is, also the higher the fees, which again is kind of what you'd expect. Better managers able to charge higher fees. The one caveat on that is there's an extensive discussion in the paper of estimating the fees, because what you're given is the kind of fee schedule from each manager, and so the authors here had to infer basically what were the fees. They chose the median and then looked at what it would have been if it was higher or lower, but we don't really know exactly what the fees are for each of these managers. And then we do this analysis where we say, well, was it worth it by looking at, could we have generated the same results simply by doing an optimal portfolio on mimicking portfolio factors, which is kind of interesting, but the authors do run into some standard problems. First of all, they don't really talk a lot about what they did, but they said they created mean variance efficient portfolios based on the historical data and the standard algorithm. Now, I assume what they mean by that is that their expected returns were just the historical returns. I'm not sure, but obviously that's not a very satisfying approach. It gives a relatively low Sharpe ratio, 0.14. And then they talk about two modifications to generate more stable and simpler to implement portfolios that avoid extreme long and short positions. And they do that by using a diagonal covariance matrix and also adding a no short constraint. And then setting negative risk premiums to zero. So again, I assume what they mean by the negative risk premiums is an asset class that, or I should say a risk factor that had a negative return over some period of time. But anyway, my comment here is it would have seemed to me that it would be a perfect application of Black Litterman, where you use equilibrium returns and shrink toward the market portfolio. But be that as it may, they get those results which suggest, and notice here that the standard portfolio, the mean variance optimization, didn't do very well. And so the two portfolios where they tried to use the diagonal covariance matrix and the no short constraint give much better results. And then they find that, you know, the fees that you actually see in the industry are more or less commensurate with what you would have to use, what you would have to pay in order to generate those returns themselves. And so therefore they kind of say, well, you're kind of getting, you know, you're kind of indifferent between using the fees on the institutional mutual funds that would give you the mimicking portfolios versus the active management. Again, not particularly a surprise. And then the bottom line conclusion is, and so this is really what this paper is trying to say, what do we learn about the future of active management? And they say, well, the introduction of liquid low-cost ETFs is likely eroding the comparative advantage of asset managers, and I would say yes, indeed. There are a couple of caveats associated with, there not being liquidity with these ETFs, at least certainly not at the beginning of the sample. It takes a little bit of work to do this, so maybe less sophisticated investors couldn't do it. A lot of us in the active management industry, I would say, are asking difficult questions of ourselves about what our clients really paying us for, and what is going to happen to active management fees. And I would agree with the author's conclusion, which is there's going to be a lot of pressure on active management going forward. We should expect to see increases in passive indexing. We certainly are seeing that. Increases in ETFs, increasing outsourced CIO management, and smart beta and factor-based investment strategies. So all of this makes sense. It was nice to see it sort of supported in this database. And with that, I'd like to invite Joe to come up, and maybe we can take some questions from the audience.
Thank you for a wonderful discussion.
No, well, thank you, Joe. So we'll just share the mic here, and if there's any questions, just raise your hand. There's one back here. Right here next to the mic, I think.
Hi, Ron Kahn from BlackRock. I just had a question about when you did the style analysis, to what extent were the style exposures static? You mentioned you had lots of different methods, but I didn't understand the end results. Were these basically static exposures to styles?
We allowed the exposures to be dynamic, and the results were basically the same as when we did it when they were static.
Okay, so you tried it both ways and you got
We tried several different ways to do them dynamically, and each time they were basically the same as the static.
So that would imply that it's not timing of styles that's really contributing.
No, it's not timing of styles, it's exposures to the factors over the sample period, which we were surprised. We thought our prior was that it was going to be more dynamic.
Thank you.
Hi, this is Lee from Instrument Capital. I had a few questions. So can you talk about the distribution of the fund managers that do outperform? Is it like the top decile or top, few, like quartile outperform a lot, so it's worth it to be with those managers? And also with the mutual fund data research in academia, it shows that there's no persistence. So do the active managers outperform in the institutional side? Do they actually show persistence?
You've just asked the research questions for our follow-up project.
Got it. Okay.
Those are both very good questions that we've talked a lot about. We have not addressed those questions yet. The other thing that related to that, another question that we have is, what is the performance flow relationship in this sector? We want to ask, we haven't done it yet, but we want to look at the persistence, what are the characteristics of the managers who outperform, and what do the performance flow relationships look like in this sector? Unfortunately, we haven't gotten there yet. And I hate to say this, we've been working on the project for 4 years, so it may be a couple years before I have those results for you.
We have a question up here.
Two short questions. One, in judging the risk of the portfolio relative to the benchmark, judging whether there is, as you used the term, gerrymandering, in a sense, we could have two portfolios have the same standard deviation. If they have a correlation of 0.9, we'll come with 0.9. It doesn't mean that the benchmark is lower in risk or higher in risk. It just means that the portfolios are less than perfectly correlated, even if they have the same standard. So we should use another standard to judge whether that differs with respect to risk.
I didn't hear the last part.
We should use another standard whether the benchmark is lower risk than the actual portfolio. You can't judge that just by regression of a beta, because they could have exactly the same standard deviation, and by definition, if they're not perfectly correlated, the beta would be less than 1. The other question I had is that managers are choosing their factors ex ante, the factor loadings. And when we go back and fit them over a period to create this passive portfolio, we're aren't we somehow discounting the ability that the managers displayed in choosing the particular factor loadings?
Let me start with the second question. I'm not discounting, this is kind of a big debate in academic finance right now. What is skill? So the traditional view of skill in the academic literature is you take a 3-factor, 4-factor model and you look at alpha and alpha skill. But there's an important point. It's like, that's great, but as an investor, could I have traded HML? Could I have actually gotten those exposures to HML over the sample period? So when I look at these exposures and I see, you know, these managers in our sample period generate these exposures, I view that as a form of skill. On the strategy benchmarks, this is a big issue. This is something we're digging into right now. It's not clear what the best way to approach it is.
Any more questions?
Hi. I didn't quite see all the analysis of the factor mimicking portfolio, but it looks like you use, you know, indices and in some cases value indices to mimic the factors. And you just sort of alluded to this. You said, I think you were trying to say those were tradable.
We tried to make them, I mean, we tried to find indices in which you, in theory, were tradable. Now the next question is, even if they were tradable, was there sufficient liquidity?
Yeah, but I mean, like, so you didn't get at, you know, what a lot of your colleagues would do is just look directly at the long-short factor exposures that are now available in, you know, alternative beta form rather than, you know, they probably weren't available at the time. But then if you're trying to investigate the value add of this industry over that period, you know, just delivering some kind of mimicked combination of indices is one thing, but if the managers were actually delivering exposure to more explicit factors, that might have been an additional value added that you didn't really investigate in this. So in other words, getting at the fact that the indices are not even close to pure plays on these factors.
No, I mean, but one way to think about it is maybe these pure play, the way you're talking about these, I don't know, exotic might be the way to say it. Maybe they represent some sort of combination of these tradable, of these common indices, but yes.
I'm saying if you would have discovered factor loadings on more pure factors, I guess the next conversation is going to be a debate about alpha or beta or exotic beta or whatever, but the delivery of exotic beta over this period from 2000 to 2012 might have warranted, you know, substantial fees. Right?
Oh, I would, I would say the takeaway from our analysis is over that sample period, it warranted the fees. I mean, I would say the takeaway from our analysis is, you know, on average, institutional investors were at a point of indifference. So
it would have been more than indifferent or less, depending on how it would be on the pure factor loadings rather than...
yeah, I mean, there's going to be heterogeneity, absolutely. Other questions?
Hi. Hello. Hi. Thank you. Mikhail from Forefront. One follow-up question to that. I mean, regressions on like momentum factor, which was found in retail funds, would be interesting if you did that or not. And part B, to validate that positive, just call it excess return, no regressions, and we see negative results in retail mutual funds. Have you done it, or would it be possible to do the overlapping where the institutional manager also has a retail fund, and that group of overlap managers, would they still have positive excess return versus benchmarks in the retail space, just to really confirm that positive result?
We have not, what we did in our analysis is we stripped out all the retail to start. What we haven't done is done a comparison. There's some work where they do this on institutional, like Evans and Fallenbrock do this with respect to institutional and retail mutual funds with the same family. We haven't done that in this analysis yet. No, we haven't done. That's again following up on our next steps.